Yesterday, the Department of Statistics released the trade balance figures. Now, the trade balance figures effectively show the difference between the exports that New Zealand makes and the imports that it takes in. Contrary to analysts' expectations, there was actually a deficit in terms of that trade balance, which basically means that we imported more than we exported. And there were two primary reasons for this. Firstly, we imported a significantly large aircraft at around $215 million. The second point relates to oil, and basically it showed that we imported much more oil than we exported. This doesn't actually show a fundamental change in the amount of oil that we're consuming. It has a lot to do with the actual shipment timings. So if you have a significant amount of imports coming in, and while your shipments outwards are delayed, it creates that deficit number. Despite the fact that the reasons for the deficit were readily explainable, there was almost an immediate impact on the New Zealand dollar, which fell against the US by about 1/4 cent. However, overnight, very good economic data out of the US relating to manufacturing and in relation to housing reversed that position, with the Kiwi getting to almost 84 cents US this morning. That was also reflected on the Dow, which also increased overnight and breaking through the 13,000 point barrier again. Local markets, however, were somewhat more subdued, with both the Kiwi and the Aussie giving up. Let's take a closer look at those trade balance figures because they show some interesting things for the agricultural sector. Looking first at dairy, they confirm what everybody knows. Dairy is having a very strong season this year, with dairy exports up very high relative to previous years. It's estimated that this year, dairy exports will earn the country around $13 billion worth. Looking at last year, that's up from $11.5 billion. In the meat side of things, though, the picture is slightly different. The figures confirm that, as expected, meat exports are way down. In fact, on the seasonally adjusted 3-month average, they're down to levels of around 1999. Sooner or later, though, that stock is going to end up going to the market and to be exported, and that will have some detrimental impacts on prices at farm gate going later in the season.